Right now, across California, two neighbors living on the same street are about to have wildly different years. One will save $4,200 on their property taxes in 2026. The other will pay $6,800 more. Same city, same tax rate, same ballot measures. The difference? One filled out a single-page form most people don't know exists. This isn't about income brackets or property values. It's about a parallel system of relief programs operating in plain sight, while most homeowners bleed money they don't have to lose. Before we break down who wins and who loses, hit that subscribe button right now. Discover Cities brings you housing market information that actually protects your money. And drop a comment below telling me which California city you're in, because these relief programs work differently depending on where you live. Here's what nobody tells you when property taxes climb 5%, 6%, 7% in cities across California. There's a separate economy running underneath the one you see. While headlines scream about Imperial Beach's 5.82% assessed value increase, or Poway's brutal 6.72% jump, or Los Angeles rolling out mansion taxes that reshape entire markets, there's a quieter story happening. 7 different relief programs exist right now, most launched years ago. Some expanded in 2026, and the gap between people who use them and people who don't keeps widening. Let me show you what changed between 2025 and 2026, because this matters more than the percentage increases everyone's panicking about. The Property Tax Postponement Program, which lets eligible homeowners defer current year property taxes, has an application window from October 1st, 2025 through February 10th, 2026. Applications postmarked after that deadline won't be accepted. That's a 3-month window to access a program that could save you thousands annually. To qualify, you need to be a senior, blind, or have a disability, maintain at least 40% equity in your home, and have annual household income of $55,181 or less. The deferment gets secured by a lien against your property, which you repay when you sell, transfer ownership, or die. Now here's where it gets interesting. The Homeowners Exemption provides a $7,000 reduction in taxable value for qualifying owner-occupied homes, saving roughly $70 to $80 annually. It requires a one-time filing with your county assessor. File by February 15th, and you get the full exemption for that year. But most people stop there. They see $70 and think it's not worth the paperwork. What they miss is how programs stack. The Disabled Veterans Exemption comes in 2 levels: a basic exemption available to all qualifying claimants, and a low-income exemption of $262,950 for veterans with household income of $78,718 or less. For the basic exemption, you file once. For low income, you file annually by February 15th. Think about what that means in real terms. A disabled veteran in San Francisco with a $1.3 million home and household income of $75,000 could reduce their assessed value by $262,950 annually. At California's 1% base property tax rate, that's $2,629 annually. Add the $70 homeowners exemption, that's $2,699 in annual savings from 2 forms most people never file. Now layer in Proposition 19. Approved by California voters in November 2020, Proposition 19 allows homeowners who are 55 or older, severely disabled, or victims of wildfire or natural disaster to transfer their property's base year value to a replacement home anywhere in California up to 3 times.
Here's how that works in practice. You're 62 years old. You bought your home in Chula Vista in 1998 for $250,000. Your current assessed value sits at $380,000 after years of 2% annual increases under Prop 13. But similar homes on your street are selling for $750,000. You want to downsize. Under the old system, buying a new home meant getting reassessed at current market value. Buy a $600,000 condo, pay property taxes on $600,000. But under Proposition 19, you transfer your $380,000 base year value to the new property. You're paying taxes on $380,000 instead of $600,000. That's a $2,200 annual savings every year for as long as you own that property. And you can do this 3 times in your lifetime. Move once for health reasons. Move again to be closer to family. Move a 3rd time when you need assisted living nearby. Each time, you carry that low tax base with you. The programs exist. The money is real. But here's what separates winners from losers in 2026. 3 categories determine everything: exemptions, deferrals, and base year value transfers. Exemptions reduce your assessed value permanently. The Homeowners Exemption, the Disabled Veterans Exemption. These don't go away unless you become ineligible. Deferrals postpone payment. The Property Tax Postponement Program. You're not avoiding taxes. You're pushing them to a future date when you sell or transfer the property. Interest accrues on deferred amounts, but for someone on a fixed income facing a $6,000 annual property tax bill, deferring that payment can mean the difference between keeping your home and losing it. Base year value transfers let you move without triggering reassessment. Proposition 19 for seniors and the disabled, disaster relief transfers for wildfire victims. These programs recognize that forcing someone to choose between staying in an unsuitable home and facing a crushing tax increase is bad policy. But knowing the categories means nothing if you miss the deadlines. February 10, 2026 for property tax postponement applications. February 15, 2026 for most exemptions. County-specific deadlines for parcel tax exemptions that vary by district. Because of limited funding, applications for the postponement program are distributed on a first-come, first-served basis, and not everyone who qualifies may be approved. That's the part nobody discusses. The programs exist, but funding caps out. Apply early or lose access entirely. Now let's talk about the cities where this matters most. Remember those assessed value increases from the document? Imperial Beach at 5.82%, Encinitas at 5.83%, Lemon Grove at 6.26%, El Cajon at 6.40%, Chula Vista at 6.52%, Poway at 6.72%.
If you're watching from any of these cities, leave a comment right now. I want to know how these increases are hitting your household specifically. Because the numbers on paper don't capture what this actually feels like when you're writing the check. These aren't abstractions. In Poway, where the median home price sits around $950,000, a 6.72% assessed value increase means roughly $64,000 added to your assessed value. That translates to $640 annually in additional property taxes. But a homeowner in Poway who qualifies for the Disabled Veterans Low-Income Exemption and files for it, they're reducing their assessed value by $262,950 while everyone else is watching theirs climb. The gap between these two neighbors isn't $640 annually, it's $3,269. One saves, one bleeds. Multiply that across tens of thousands of properties in San Diego County alone, and you see why this matters. The programs aren't secrets. County assessor websites list them, the California State Board of Equalization publishes guides. But information doesn't equal application, and application doesn't equal approval. So who actually wins in this system? Who are the people saving $4,200 annually while their neighbors pay $6,800 more? First, people who read their property tax bills carefully. Sounds obvious, but most homeowners don't. They see the total due, they pay it, they move on. Seniors, low-income homeowners, and those with disabilities should look at their property tax bill and call the phone numbers listed next to each parcel tax to ask if any exemptions are available. Every parcel tax, every special assessment, every bond measure on your bill potentially has an exemption attached. School district taxes often exempt seniors over 65. Landscape and lighting districts might exempt low-income households. Violence prevention measures could exclude disabled residents. But you have to ask. These agencies don't proactively inform you. They list a phone number on your bill, and if you call, they'll tell you about exemptions. If you don't call, they'll keep collecting. Second, people who understand stacking. This is where real savings appear. Take a 67-year-old veteran in San Diego with a 100% disability rating and household income of $72,000. They're eligible for 3 separate programs simultaneously. The Homeowners Exemption saves them $70 annually. The Disabled Veterans Low-Income Exemption saves them $2,629 annually. And if they're paying into school district parcel taxes, those might save another $300 annually, depending on the district. Total annual savings, $2,999 for filing 3 forms, most filed once, one filed annually. But it gets better. This same veteran decides to downsize in 2026. They bought their current home in 2002 for $400,000. After 24 years of 2% annual increases under Prop 13, their assessed value sits at $643,000. They sell for $950,000 and buy a smaller place for $700,000.
Under normal reassessment, they'd pay property taxes on $700,000. But under Proposition 19, if the replacement home costs less than the original home's market value, the taxable value transferred remains at the original amount. They transfer their $643,000 base year value to the new property. That's a $570 annual savings on top of the $2,999 in exemptions. Total annual savings, $3,569. And they can do this 2 more times in their lifetime. Third, people with advisors. This is the uncomfortable truth nobody wants to say out loud. Families wealthy enough to have tax advisors, estate planners, and real estate attorneys learn about these programs during routine consultations. The advisor sees the property taxes on the client's balance sheet and asks if they filed for available exemptions. They handle the paperwork, they track the deadlines, they maximize the stacking. Families without advisors don't have those conversations. They don't know what they're missing because they don't know what exists. And the gap compounds every year. Let me give you a specific case study that illustrates this perfectly. 2 homeowners in Poway. Both own homes assessed at $900,000. Both are 68 years old. Both are veterans with 100% disability ratings. Both have household incomes around $70,000. Homeowner A has an accountant who handles their taxes. During the 2025 tax prep, the accountant notices they're not claiming the Disabled Veterans Exemption. She files the form for them. She also mentions the Property Tax Postponement Program given their fixed income. They don't need it yet, but she puts the information in their file. Homeowner B doesn't have an accountant. They use TurboTax. Their property taxes go up $600 in 2026 because of Poway's 6.72% assessed value increase. They complain to neighbors about it, they vote against local tax measures, but they never research available exemptions because they don't know exemptions exist. And the gap compounds every year. Let me give you a specific case study that illustrates this perfectly. 2 homeowners in Poway. Both own homes assessed at $900,000. Both are 68 years old. Both are veterans with 100% disability ratings. Both have household incomes around $70,000. Homeowner A has an accountant who handles their taxes. During the 2025 tax prep, the accountant notices they're not claiming the Disabled Veterans Exemption. She files the form for them. She also mentions the Property Tax Postponement Program given their fixed income. They don't need it yet, but she puts the information in their file. Homeowner B doesn't have an accountant. They use TurboTax. Their property taxes go up $600 in 2026 because of Poway's 6.72% assessed value increase. They complain to neighbors about it, they vote against local tax measures, but they never research available exemptions because they don't know exemptions exist. Homeowner A's property tax bill in 2026, $6,371. Base $900,000 assessment minus $262,950 Disabled Veterans Exemption equals $637,050 times 1% equals $6,370.50 minus $70 homeowner's exemption equals $6,301.50. Homeowner B's property tax bill in 2026, $9,600. Base $900,000 assessment increased by 6.72% equals $960,480 taxable value times 1% equals $9,604.80. The difference? $3,304 annually. Not because homeowner A is smarter,
because homeowner A had access to information through a professional relationship most people can't afford.
This is the sorting mechanism in action. The system doesn't deny relief to homeowner B, it just makes relief complicated enough that only people with resources can navigate it efficiently. And if this is making you angry, good. Comment below about your experience with California's property tax system. Have you successfully filed for exemptions? Did you miss a deadline and lose thousands? Are you a tax professional watching homeowners make preventable mistakes? Share your story because other viewers need to hear it. Fourth, people who apply early and follow up aggressively. Remember how the Property Tax Postponement Program has limited funding? Applications are distributed on a first-come, first-served basis, and due to funding limitations, not all who qualify may be approved. The application window opens October 1. People who mail applications in early October get approved. People who wait until January might get waitlisted. People who miss the February 10th deadline get nothing. Same thing happens with school district parcel tax exemptions. Most have May or June deadlines for the tax year starting July 1. Some will grant an exemption retroactively for applicants who miss the deadline. Many will not. The winners in this system aren't necessarily the most deserving. They're the most organized, the most informed, and the most persistent. Fifth, people who moved strategically under Proposition 19. Proposition 19 allows homeowners 55 and older, disabled or victims of wildfire or natural disaster, to transfer their assessed value to a replacement home anywhere in California up to 3 times. Before April 1, 2021, when Proposition 19 took effect, property tax portability was severely limited. You could only move within your county or to certain reciprocal counties. You could only do it once in your lifetime, and the replacement home had to be equal or lesser value. Proposition 19 eliminated all those restrictions. Now you can move anywhere in California. You can move 3 times, and if you buy a more expensive home, you just add the difference to your transferred base year value. If you sell for $1,200,000 and buy for $950,000, you transfer your entire factored base with no adjustment. But if you buy for $1,500,000, you add the $300,000 difference to your transferred base. This changed everything for people who bought California real estate before 2000. They're sitting on assessed values 1/3 or 1/4 of current market values. Proposition 19 lets them move without losing that advantage. The winners are the people who understood this immediately and planned accordingly. They're downsizing from $1.2 million homes to $800,000 condos and cutting their annual property taxes in half. They're moving from expensive coastal cities to cheaper inland areas while keeping their low tax bases. They're relocating near family, near medical care, near support systems without financial penalty. And they're doing it up to 3 times. This isn't a one-time benefit. It's a lifetime advantage that only certain age groups can access.
Now, let's talk about who loses, because the losers in this system aren't failing. The system is failing them. First, middle-income earners who don't qualify for means-tested programs but can't afford advisors. The Property Tax Postponement Program requires annual household income of $55,181 or less. The Disabled Veterans Low-Income Exemption requires household income of $78,718 or less. If you're a couple earning $85,000 annually in California, you're not wealthy. You're middle class. You're probably stretching to afford your mortgage, your property taxes, your insurance, your cost of living. A 6% increase in your assessed value genuinely hurts your budget. But you don't qualify for postponement. You don't qualify for the Low-Income Veterans Exemption if you're a veteran. You're making too much money for relief, but not enough money to absorb the increases comfortably.
And you definitely can't afford to pay a tax advisor $2,000 annually to handle your filings. You're doing your own research, reading your own county assessor websites, trying to figure out which forms apply to you. This is where the system breaks down. The people who need help most are the ones falling through the eligibility cracks. Second, recent buyers getting crushed by reassessment. Under Prop 13, when you buy property in California, it gets reassessed at current market value. That becomes your new base year value, and it can only increase 2% annually after that, unless you trigger another reassessment. Someone who bought a home in Chula Vista in 2023 for $750,000 is paying property taxes on $750,000. Their neighbor who bought an identical home in 2003 for $320,000 is paying property taxes on roughly $470,000 after 20 years of 2% increases. Same house, same street, same services. Wildly different tax bills. The 2023 buyer doesn't qualify for any base year value transfers because they don't have a low base year value to transfer. They can't use Proposition 19 to move and save money because their assessed value already reflects current market prices. They're locked into the highest possible property tax burden, while their longer-term neighbors enjoy the benefits of programs designed to protect people who've owned property for decades. Third, people who inherit property and don't understand the new rules. Before February 16, 2021, when Proposition 19's intergenerational transfer provisions took effect, California had generous parent-child transfer exclusions. Parents could transfer their primary residence plus up to $1 million in assessed value of other property to children without triggering reassessment. Children could inherit rental properties, vacation homes, investment properties, all keeping their parents' low Prop 13 tax bases. Some adult children who never lived in California owned multiple rental properties in San Francisco or Los Angeles, paying property taxes based on 1970s purchase prices.
Proposition 19 eliminated most of that. Now the exclusion only applies to a family home if the property continues as the family home of the transferee, and the transferee must live in the home as their primary residence within 1 year of transfer. There's a limit to the value that can be excluded, the property's taxable value at time of transfer plus $1 million, adjusted every other year by an inflation factor. What this means? If you inherit your parents' $2 million home that has a $400,000 assessed value and you move into it as your primary residence within 1 year, you can keep the $400,000 assessed value plus $1 million. Your new assessed value would be $1.4 million instead of $2 million. But if you don't move in within 1 year, or if you don't file for the homeowners exemption within 1 year, you lose the exclusion entirely. The property gets reassessed at $2 million. Your annual property tax bill jumps from $4,000 to $20,000. Counties emphasize that you must file these forms yourself. Escrow companies don't handle inheritance transfers. The assessor won't send reminders. Many families learn about the requirements months or years after a transfer, by which time they've already lost benefits worth thousands of dollars. This is happening across California right now. Adult children inheriting their parents' homes, assuming the low property taxes transfer automatically, and getting reassessment notices 18 months later showing 5-figure annual property tax increases. They're losing tens of thousands of dollars because nobody told them about a filing deadline they didn't know existed. If you've gone through an inheritance situation in California, drop a comment about how you handled the property tax transfer. Did you know about the 1-year deadline? Did you file in time? Your experience could save someone else from a massive mistake. Fourth, people in cities with aggressive new local taxes. The property tax relief programs we've been discussing are statewide. They apply everywhere in California, but cities are layering on new parcel taxes, transfer taxes, and special assessments that aren't capped by Prop 13 and aren't covered by most exemption programs. Los Angeles passed Measure ULA, the mansion tax, increasing transfer taxes to 4% on properties between $5 million and $10 million and 5.5% on anything above $10 million. That's destroyed the luxury housing market. Sales have plummeted, building permits are down, developers are fleeing, but it also created a blueprint other cities are watching.
San Francisco's mayor is pushing a parcel tax ballot initiative for November 2026 to fund Muni Transit. If it passes, homeowners will pay an additional $99 to $325 per parcel annually. Berkeley is battling over measures that could cost cities tens of millions of revenue if passed, which means Berkeley will likely respond with new local taxes to cover the shortfall. Every local ballot measure that passes means another line item on your property tax bill, and most of these don't have exemptions, or if they do, the exemptions are poorly publicized, require annual applications, and have income limits that exclude middle-class homeowners.
The losers here are people living in cities with revenue crises. Their statewide relief programs still exist. They can still file for exemptions, postponements, and base year value transfers, but the local add-ons are overwhelming those savings. Fifth, people who don't speak English fluently or don't have internet access. Every application form for these programs is in English. Most county assessor offices have websites where you download forms, read instructions, and submit documentation electronically. Some have phone numbers you can call for assistance, but those offices are understaffed and hard to reach. The California Mortgage Relief Property Tax Assistance Program, which provided up to $20,000 to cover past due property taxes for homeowners facing pandemic-related financial hardship, had income and eligibility requirements, but applying required internet access, the ability to navigate a complex application portal, and documentation in English. Immigrant homeowners, elderly homeowners without family nearby to help with paperwork, disabled homeowners with cognitive challenges, they're all less likely to successfully navigate these programs even when they qualify. The system isn't denying them relief intentionally, it's just designed in a way that creates barriers they can't easily overcome. So, what do you actually do with this information? If you're a current homeowner in California, 3 things matter in 2026. First, pull your most recent property tax bill right now. Go line by line, every charge, every assessment, every parcel tax. Write down to phone numbers or website links listed next to each charge. Call them. Ask what exemptions exist. Don't wait for them to tell you. They won't proactively inform you. You have to ask specifically, do you offer any exemptions for seniors, veterans, disabled individuals, or low-income households? What are the eligibility requirements? What's the filing deadline? Document everything. Which exemptions you qualify for, which deadlines you need to meet, which forms you need to file. Put reminders in your calendar for every deadline. Second, check your assessed value against current market value. If you bought your home before 2010, there's a strong chance your assessed value is significantly lower than current market value. That gap is your advantage if you ever need to move, but only if you understand Proposition 19 and plan accordingly. If you're 55 or older or severely disabled and you're thinking about moving in the next few years, research base year value transfers now, not when you're ready to move, now. Understand how the market value difference gets calculated. Understand the 2-year timeline requirement. Understand the filing process. You must file Form BOE 19B with the county assessor where your new home is located, and you must own and occupy the replacement as your principal residence when you file. These details matter. File late or file incorrectly, and you lose the benefit entirely. Third, if you qualify for any means-tested programs based on income, disability, or age, apply immediately. Don't wait until deadlines approach. The Property Tax Postponement Program application window runs from October 1st, 2025 through February 10th, 2026, and funding is limited with applications processed on a first-come, first-served basis. Apply in October, not January. Apply in person or by mail, not online if the online portal has issues. Follow up 2 weeks later to confirm they received everything. Follow up again 4 weeks later to confirm approval status.
Treat this like you're fighting for something valuable. Because you are. You're fighting to keep thousands of dollars annually that you would otherwise pay unnecessarily. If you're thinking about buying in California, the calculations just changed. Property taxes aren't just the 1% base rate anymore. You need to add parcel taxes, special assessments, bond measures. In some cities, the effective rate is 1.5% or higher. A $750,000 home in Chula Vista doesn't cost $7,500 annually in property taxes. It costs closer to $9,000 when you include everything. And those costs are rising faster than the 2% annual cap on base assessed values. Run the real numbers. Factor in projected increases. Add local ballot measures that might pass in the next few years. Add the possibility that you won't qualify for relief programs because you're not old enough, disabled enough, or poor enough. Then ask yourself honestly, can I afford this in 3 years? In 5 years? In 10 years? Because California homeownership is becoming unsustainable for middle-class families. Not because of home prices alone, because of the tax structure layered underneath those prices. The only way to protect yourself is to stay informed, not generally informed, specifically informed about your county, your city, your exact property. Subscribe to your county assessor's email updates. Join local homeowner Facebook groups where people share information about exemptions and applications. Follow local ballot measures so you know what's coming. The system is designed to reward knowledge. People who know the rules, know the deadlines, know the loopholes, they're saving thousands annually. People who don't know are funding everyone else's relief. Which side of that divide you fall on is your choice, but you have to make it actively. Doing nothing is choosing to pay more. Here's what this all comes down to. Property tax relief in California exists. The programs are real. The savings are substantial. But the system isn't designed to help you. It's designed to let you help yourself if you can figure out how. Winners in 2026 aren't the wealthiest homeowners. They're the most informed ones, the ones who read their bills carefully, the ones who file early, the ones who stack programs strategically, the ones who plan moves around base year value transfers. Losers aren't the poorest homeowners. They're the ones just above income limits who can't qualify for means-tested relief but can't afford advisors to navigate the complexity. They're recent buyers with no low tax base to protect. They're families inheriting property who miss filing deadlines they never knew existed. The gap between these two groups keeps widening. Every year, the informed get better at optimizing. Every year, the uninformed fall further behind. And every local ballot measure adds another layer of complexity that advantages people with resources. If you own property in California or you're thinking about buying, you need to understand this isn't just about rising home prices anymore. It's about a property tax system that's fragmenting into different tiers of burden based on knowledge, age, disability status, income level, and how long you've owned your home. If you found this breakdown valuable, subscribe to Discover Cities right now, recovering the California housing market stories that mainstream media ignores, the ones that actually affect your bank account. And comment below with the single biggest property tax challenge you're facing in 2026, because I read every comment and these shape what we cover next. You can navigate it successfully, but you have to treat it like a part-time job. Research, applications, deadlines, follow-ups, year after year. Or you can ignore it and hope things work out. But hope isn't a strategy when your property tax bill is climbing $600 annually and your neighbor's is dropping $2,000 because they filed 3 forms you didn't know existed. Your home is probably your largest asset. Your property taxes are probably your largest recurring expense after your mortgage. Optimizing that expense should be a priority, not an afterthought. The information is out there. The programs are available. The question is whether you're going to access them or let them pass by while your bills keep climbing. That's the real divide in California's property tax system. Not rich versus poor, not homeowner versus renter, informed versus uninformed. Which side are you on?